So what we're going to talk about during our session is let's take the dysfunction out of your functional statement. As we were going through and trying to figure out the different areas to talk about this year, one of the good things is the FASB hasn't put a lot of additional guidance out. They kind of left us alone here for a little bit in the last couple of years. So we decided that a good topic would be to talk about your functional statement. And can we get the right thing on the screen, please? Yeah. Okay, so our outline that we're going to be talking about is the functional expenses, and we're going to talk about the who, the what, the why, and the how. The how, talking about, there we go. Talking about the, they had the tax part up there for me, and that's not my area.
You've done this for 24 years. You could probably teach that.
Maybe. I have a little bit of experience in that, enough to be a little bit dangerous, but I'm not an expert.
We'll leave the you, but to Shannon.
Yes. So, and then the fourth one was how. So we're going to talk about the direct identification and allocations. We're going to talk about the allocation methodologies. Angela's going to go through and talk more about how to track your expenses and the tools to do that. We're going to talk about the common pitfalls and best practices. So one of the things that we talk about too when you talk about functional statements is that although there are some direct allocation methodologies or you're directly allocating expenses, but there's also a lot of estimation in here. So you could have a lot of allocations. Are you trying to get it go forward?
So I see in the chat that we have some concerns about that QR code again. We will note that as we do the polling questions today, each polling question slide will also include that QR code. And that QR code does take you to the same area as the login for the link that was shared by Dannible. So that dmcps.cnf.io login through your browser. So don't worry, that QR code will appear periodically throughout our slides. So let Peggy get into the who of functionals.
The who. Okay, so all nonprofits must follow the AISBA accounting guidance on functional expenses, including but not limited to charitable organizations, 501c3s, nonprofit healthcare entities, churches and religious organizations, private foundations, and other nonprofits. So there was I don't know how many years ago it was that the FASB put out guidance. The functional statement was not a required statement for all entities, but they thought it was important enough and made it a requirement for just about every nonprofit organization. So what is a statement of functional expenses? Okay, so your functional statement represents your allocated cost to the readers of the financial statements. Function defines the purpose of an activity, a purpose or activity, and expense supports typically categorized such as program services. So, obviously as a nonprofit organization, your main goal is to provide program services. You may have one main program services, or you could have multiple ones that would be meaningful to disclose in the functional statement. The next one, the two remaining ones are the management in general and fundraising, and those are your supporting services to the program services. One of the things that that we didn't put in here, and it's I don't see it very often, but the FASB does have some guidance on a 4 category for membership. So if you are a membership organization, there's the potential to break it out into membership as well. The next area, nature and natural classifications, refers to the intrinsic type of or substance of a cost. So examples include salaries, rent, depreciation, office supplies, etc. So like when you're looking at your functional statement on the left-hand side, you'll see all of your natural classifications of your expenses that have been either directly allocated to your functions or some sort of allocation methodology. Okay, so your functional statement may be presented on the face of the statement of activities. So if you're a small enough organization and you can actually fit it there, it is allowed. You are allowed to put it in the notes to the financial statements or its own statement on the face of the financial statement. So typically what we do, not always, but it depends on the size of the organization and the financial statements, but typically we would have a separate functional statement. Note, including the statement of functional expenses as a supplemental schedule to the financial statements does not meet the reporting requirements. So we used to do that when it wasn't required, sometimes having as a supplemental statement, but that does not meet the requirements at this point. Okay, your functional statement may be presented comparative or with prior year summarized totals. So what that means is when you're looking at your functional statement, and it can get quite large sometimes, you'll have your natural classification, you'll have your programs, management in general, fundraising, and a total for, let's say we're doing 2025. And then if you repeat all of those columns for your programs, your management in general and fundraising in the prior year category, that is considered to be fully comparative. The guidance does allow you to only show the current year and have all those columns, but also, and then just have a total for the prior year. So that would be with prior year summarized totals. So, and if you choose to do that, if only presenting prior year summarized totals, the notes should indicate that the statements should be read in conjunction with the prior audited financial statements from which the information is derived. So you'll see typically in note 1, a disclosure on that, just letting the reader know, there is some further information. Go look at last year's financial statements if you want to see the details. Okay, nearly all expenses should be included in the statement of functional expenses as program management in general or fundraising with a few exceptions. So these are a couple things. So we have the investment expenses, the gains and losses, the cost of goods sold, and the cost of direct benefits to donors. Okay, so the investment expenses. So the FASB has guidance out there that internal and direct internal investment expenses that have been netted against investment return should not be included in the analysis of expenses by nature and function. So really when you're looking at your statement of activities, your profit and loss, investment income is the expenses are directly netted against that. So therefore, since it's up in the revenue section, you're not going to show it in your expenses down in the functional statement. Okay, gains and losses. So certain items that are typically excluded from net income of for-profit entities, such as those items listed in FASB's ASC 220, 10, 45, 10A are considered gains or losses, and like other gains and losses should be included in analysis of expenses by nature and function. Should not be, I think I said should.
Yeah, should not be included.
Okay, so examples, gains and losses on investments. So you'll always see those up in the revenue section, regardless of whether it's a loss, which you would think, okay, that's an expense, but it still stays up under the revenue section. Gains and losses on foreign currency adjustments, and then gains and losses on post-retirement benefit obligations.
And there is a very comprehensive list in the guidance, if you all feel like doing a little bit of light reading. So we're going to...
Angela's going to take over. There we go.
We're going to talk a little bit about cost of goods sold. Many nonprofits that we work with don't have cost of goods sold, but there are organizations out there, I know, that are providing services in exchange for compensation. So according to the FASB guidance, and you can see the exact reference there, The cost related to sales of goods and services, how they're displayed depends on whether the sale is a major or central activity of the nonprofit or peripheral or incidental activity. So of the main activity that your organization does, are you mainly being paid for services directly provided to individuals for their own benefit? Or are you, maybe you have a gift shop, whereas your main purpose is to educate the public via a museum? So whether or not it's major is going to determine how you are going to present them. So, for example, a nonprofit museum that has a store that is a major or central activity should report and display separately the revenues from the store sales and the related cost of sales. Cost of sales is permitted to be reported immediately after revenue from sale of merchandise and may be followed by a descriptive subtotal, or cost of sales may be reported with other expenses. As I go through these ifs, I am going to have a few slides to show you some examples of how this looks. So if the store sells merchandise that is related to the museum's program, the store would be a program service, and the cost of the store's sales would be reported as a program expense. So is that museum selling stuffed toys, or is that museum selling educational materials? In other circumstances, cost of sales could be reported as a separate supporting service. For example, if operating a cafeteria is a major essential activity, but it's not related to the nonprofit's programs, the cafeteria cost of sales would be reported in supporting services. So maybe you're a very large nonprofit that has a cafeteria that serves your employees, but is not open to the public. That would be different than if you operated a cafeteria at a childcare center for the purpose of feeding the children. Next, we're going to talk about direct benefit to donors. This is another area that has some nuance. Here we're talking about benefit to donors often during fundraising events, but we'll go through the specifics here. So as discussed in the Q&A section, 6140.08 from the AICPA, the functional category of the cost of direct benefit to donors that are not program related should be reported as a separate supporting category, such as cost of sales. If the benefits are provided in exchange for transactions, they should not be reported as fundraising. So what do I mean when I say an exchange transaction? An exchange transaction is when you are providing a service or a good to the public, to other organizations, and the individuals are getting a direct benefit, as opposed to a activity that is for the greater good. So if the donor benefits are provided in transactions that are not exchange transactions, such as a fundraising dinner for which there is no charge to attend, the cost of donor benefits should be reporting as fundraising unless they are program related. So this is not a exchange transaction because the purpose of that dinner is fundraising. Some nonprofits conduct joint activities that are special events, such as symposiums, dinners, dances, and theater parties, in which the attendee receives a direct benefit. So they're getting a meal, they're getting a theater ticket, they get to see a show, they're getting entertainment, and for which the admission price includes a contribution. So in that case, the contribution revenue is shown net of the expense that was a direct benefit. We see this often with golf galas, golf tournaments, in that the individuals are attending, they're paying a fee, but they're also getting that direct benefit that is the experience that is the gala, the beautiful golfing on whatever course CNY has to offer. So here we have a few different examples of how that direct benefit to donors can be shown. So in case A here, you can see there are contributions of $200. There's special event revenue of $100, and they're backing out the direct cost of benefit to donors right below that special revenue line. So it's showing up net in your income section. Down below, you can see net revenues from special events of 75, contributions and net revenues of 275, etc., to get you down to your total expenses. So in that case, you are backing out the cost benefit to donors just below your special event revenue. In case B, you have revenues, contributions of 200, special event revenue of 100, total revenues of 300. That direct cost to benefit to donors is actually down below in your functional under program, direct cost benefit to donor, management in general, etc. So whether or not it's going to go net or whether it's going to go down in your expense category depends on if it's incidental, if it's major, and the nature of the fundraising activity. In case C, the contributions are shown of 270. There are dinner sales of 30. You're backing out your direct cost of benefits of 25. So in this case, your contributions are higher because there was a contribution included in the ticket to the dinner sales. And that's the difference between contributions of 200 and dinner sales of 70 versus contributions of 270 and dinner sales of 30 compared to contributions of 200 and direct cost of benefit to donors of 25. So really how your scenario looks is going to depend on your organization. And if you're not sure which scenario you would fall under, you would want to consult your accountants. We'll talk later about different ways you choose how to allocate. A big takeaway is always to consult with your accountant if you're not sure of what your presentation should be. Here we have an example of what your statement of functional expense may look like. So in this case, you can see the natural classification that Peggy was talking about. So when we say natural classification, we're talking about what actually is the expense. So like we mentioned, salaries and wages. Other items in here might be meals and entertainment, occupancy. Some organizations may choose to show rent expense on its own separate line. Some organizations may choose to show utilities and other occupancy all grouped into one line with your rent. The purpose of this is really transparency to your readers. So if you're just using a very general category like program expenses and office supplies, and those are your only two lines, in general, you would need to do some work to break out more detail there. Along the top of this example, you can see program services, management in general, fundraising, and in this case, they did an example where they're showing the direct cost of benefit to donors down in that expense area. So this is a comparative with summarized prior year comparative information. So you can see here the current year is all broken out in detail and the prior year just has totals. That is one of the options we were talking about earlier. So we're going to go into our first polling question. Again, these are required if you want to receive credit today. The QR code is up again. The link is also typed out in the chat. So let's hear your thoughts. Which of these costs would be excluded from my statement of functional expenses? So which one of these shouldn't be on your functional expense statement? You've got your credit losses, formerly known as bad debt, your depreciation expense, salary expense, or loss on a fixed asset. One of these things is not like the other, even though a couple of them may seem similar. Just a few more seconds. We've got some poll results coming in.
They were listening.
Congratulations. We have a smart group with us today. You're correct. The loss on the sale of fixed assets should not be included in our statement of functional. So in this scenario, any kind of loss of fixed assets is going to show up on your income side on your revenue side of your statement of activities, and therefore not in your functional expense. Credit losses actually do show up in your functional statement, but whether the nature of the credit losses relates to direct program services or administrative non-program services would determine whether it's management in general or whether it's program.
Okay, now we're going to answer the question of why. So why are we doing this? It's required by generally accepted accounting principles. So ASU 2016-14 presentation of financial statements of nonprofit entities requires not-for-profit entities to report expenses by nature and function. And as Angela mentioned a couple of times when she was talking, it's about transparency. We're talking about allowing the readers to understand the impact of their donations. It helps grantors to assess the fiscal responsibility of the organizations. It improves reporting for board and management oversight. And it's also required for the IRS reporting. So Form 990 requires 501c3s and 4s organizations to report the breakdown of expenses between the three classifications. So it's just, it's really about the transparency. It's about, when you're looking at the functional statement and you're trying to show what your organization is all about for purposes of trying to get more contributions in, trying to get grants in. These organizations or individuals want to see what you're spending your money on. So they want to see that you're spending more money on your program services rather than on your supporting services, management in general, and fundraising. So the how, the methodology. So there's a couple different areas. So our allocation methods, the direct identification or a reasonable allocation. Okay, so direct identification is the preferred method whenever possible and practical. So it involves allocating actual expenditures incurred related to a specific program, supporting service, or grant. So just keep in mind, like, let's take salaries. If you take a look at the duties of your individuals and your staff members, what are they doing? They may be 100% program related, so that makes an easy allocation to program for them. And it may be their salaries, their benefits, and various other items. Reasonable allocations. There are times where direct identification is not possible or practical. When determining which method, consider such factors as do costs benefit multiple programs or functions? Do costs of tracking for specific identification exceed benefits? Are total cost categories material, or are costs specifically defined by the accounting guidance? So there's a lot of different ways that you can do allocations. I think when we see in our audit practice, depending on the organization, if it's a smaller organization, they may not do a whole lot of the allocations. They may just kind of rely on us at the end of the year to do an overarching, let's take salaries and, allocate it between like the 80% program and 20% management in general. But there's really a lot that goes into that. So you could have it as simple as that, or there's could be a multi-pronged way of doing your allocations.
Yep, and we'll go through that in a little more detail later. But right now we're talking about just the reasonable allocation methods.
So the objective methods of allocating expenses are preferable to subjective methods, and the allocation may be based on related financial or non-financial data.
So what do we mean when we say objective methods? We're saying that these are items that we know belong specifically to this program. If it's an invoice that was purchased for a specific event, it gets allocated to fundraising. If it's purchased for a specific project for a specific grant, it gets allocated there, as opposed to that, I think it's about this percentage at the end of the year. It's always a estimate. Judgment is going to be involved, but anywhere you don't have to guess is more beneficial to your readers.
Okay, so common allocation methods, time and effort reporting. So I know we get a lot of pushback sometimes with this, but yeah, our recommendation would be having some sort of timesheet for your staff to really detail whether they're working on program management in general. So time sheets or activity logs. You can use headcount or full-time equivalents. You could use square footage for occupancy. But also keep in mind too, if you have a staff person who is part program and part management in general, when you're allocating them their salaries in that way, if they have their own office and we go and look at the square footage, this is where you might get into a little bit more detail, is that we have to do it based upon the square footage overall for that office. But if that person that's in that office is being split between program and management in general, then we also have to do another allocation. So it can get a little bit complicated, but those are the best practices on how to do it. So direct usage or consumption, percentage of revenue or transactions processed, or as I was talking about, the hybrid or layered allocation approaches. Okay, selecting and applying allocation methods, matching the method to the nature of the cost. Having consistency across the period. So, as you go from year to year, yes, you can make changes, but it really should be pretty consistent going from year to year. Documentation of the methodology and the assumptions so that everyone knows how that's being done. Periodic reassessment and updates, and avoiding overly complex or unsupported methods.
So we're going to go through some of the common costs and allocation bases that some of your organizations may see. So starting out with your personnel costs, we've touched on those a bit. That would include things like your salaries, wages, payroll taxes, benefits. Depending on your organization, we most often see salary as one line in your functional, and then employee benefits and taxes in another line. How you do your presentation really depends on the materiality and circumstances of your organization. And when I say materiality, you might go, well, what do you mean when you say that? We'll talk about that a little later. But in general, materiality is what level of cost do I think is going to affect the decision-making of the users of my financial statements? Am I a small organization and every dollar counts? And if I have an error, the user of my financial statements cares if we have misallocated $50. Or am I a multi-billion-dollar organization where $1,000 is a drop in the overall bucket? And it doesn't matter if it was reported to salaries when actually that was a tax expense. So with that in mind, how are we going to allocate these costs? Personnel costs, a common allocation base is time and effort reporting or job duty estimates. Many salary and payroll providers actually provide function tracking where you can allocate your employees to a department code where your payroll register will just give you the total hours and then you can split your costs accordingly. Some reports will actually summarize, so you'll just get your totals by those departments that you set up. Other notes are best practices in this regard. Salary and personnel costs are a very high audit focus. Later today, we will be talking about preparing for audits and best practices. So just keep in mind, salaries are highly scrutinized often. Documentation is critical in that respect. Looking at occupancy costs, as Peggy was mentioning, square footage is common, could also be headcount by area. That could include rent, utilities, insurance maintenance. So if you are allocating your rent by your square footage, it might make sense to take those same percentages and just apply that percentage to your utilities. Square footage is preferred when it is distinct. If you have a lot of multi-usage areas, then it might get a little muddy. In that case, maybe you want to consult with your accountants. Information technology might include software, hardware, IT support. So how do you allocate those? Maybe you do it based on users, number of devices, usage metrics. Your allocation base is really going to be based on your cost driver. So are you paying for software per user, by the hour? Are you buying one item for the entire organization? Are people sharing devices? Those circumstances are what's going to drive your cost base. And your best practice is to reflect actual usage. Any one of these best practices, we want to keep in mind what's practical. It may not be practical to track every minute your individuals are using their laptops. Looking at professional fees, such as legal, accounting, and consulting, common allocation bases here are direct assignment or time spent. Avoid allocation if identifiable. What we mean here, if this is a directly identified cost, if you know this is for management in general, if you know this is for a project, don't just apply that same percentage you've been applying every year. If you have one direct cost that's large, identifiable, maybe you pull that cost out of your cost fee pool before you apply that percentage to the rest of your smaller items. Looking at additional cost categories such as human resources, that could include recruiting, training, HR services, and systems. Common allocation base would be your headcount or full-time equivalents. Best practice there, proxy for level of HR support. Finance and accounting could be your accounting staff, could be audit costs, and could be allocated based on transactions processed, time spent. A note there, audit fees are often management and general expenses. Later, we'll talk about best practices and common pitfalls. One thing to note here, your functional statement should be presenting the fact of the function. If an audit is an administrative requirement, it's going to be a management and general expense on your functional allocation. Does that mean you can't allocate it to your grants? Not necessarily. Your grant accounting will have rules that are communicated through their contracts. We talked about contracts a lot last year. Your contracts will tell you maybe you are allowed to bill audit fees. You want to make sure that you're tracking how it's recorded in the general ledger, how is it recorded in your vouchers, and just keep detailed documentation if there's any kind of disconnect between where it's allocated in your accounting system compared to how it might show up on your vouchers. Looking at executive management, CEO and leadership costs would fall under this category, and are often based on time and effort estimates, and they're often partially allocable. So what that means, there's going to be a portion of executive management that will always be management and general, with few exceptions, and the rest would be allocated between your programs and fundraising based on that time and effort. Looking at your depreciation, examples of that would be your furniture and equipment, building depreciation, maybe you have vehicles, and that can be allocated based on asset usage, square footage. So asset usage, perhaps you have a vehicle that's rented for the use of your program. You can allocate that based on square mileage if that is split between program and administrative usage. Square footage for things like the depreciation of your building. This should be consistent with how the asset is used. One last common allocation list here, you have insurance. That could include liability, director and officer, and property insurance. So common allocation bases there might be your payroll, headcount, asset value for property insurance. So you're going to match the base to your risk driver. So for example, your professional liability insurance, maybe that's allocated based on the number of employees with certifications compared to total employees. Looking at office supplies, including supplies and postage, That might be included, allocated by headcount or transaction. Again, always apply directly where identifiable. Printing and copying, that might include your copier leases, printing services, that could be allocated based on your usage logs, estimated volume. Simple estimates are acceptable as long as they're consistently applied. The trick in all of this is balancing a need for transparency and knowledge of what your expenses are doing for your organization with the practicality and time spent of actually tracking these things.
There's a question if you want one.
All right.
What is an example of bad debt expense that could be considered programmatic?
So that could be, I'm thinking immediately of childcare, where perhaps a portion is paid by DSS and another portion is paid by the parent. Maybe a parent doesn't pay. It is part of the main program. I think that would be a good example.
Yeah, I think if it's specific program specific, related revenue that's being written off, I think that would be.
Yep. And we do have a few more seconds for the poll question here.
Here we go.
So looking at the poll we just had up, what method would be most appropriate to allocate salaries? And you all chose based on hours worked on programs or activities as a % of total time, and that is the preferred method. I see a small portion of you chose the 100 program because that's what donors like to see. Well, it is true that our donors, the donors out there, like to see program. We want to make sure that we are making the decision, that management is making the decision, to actually spend the time on the programs. Just don't say we are, make it a reality. I see a concern that a screen froze on the last poll. There are 4 polls throughout the presentation. So long as you answer 3 of them, you will get full credit. And if you have technical difficulties beyond answering 1 full question, certainly reach out to us in the chat and we can discuss what we can do for you. So next we're going to go over how to track your expenses. So in this so a minute ago we talked about the allocation methods. Here, what tools do I use to allocate items? So common tools include Excel, QuickBooks, and other ERP systems. Today we're going to talk a lot about QuickBooks because it is the most common used with many of our clients, but there are a lot of ERP systems out there with a lot of good options. So Excel is a valid and valuable tool, but manual calculations can be difficult to track. Anytime the organization can utilize programs designed for expense tracking, it minimizes the chance for errors and increases efficiencies. Where you can automate, do so. QuickBooks class and customer functions are a great way to track your functional expense. And most systems have other class, project, or a similar function. Contact your service provider if you need additional assistance. So your internal expense tracking is important. It allows the organization to track your expenses among funding sources, which we talked about last year a lot about grants. Evaluate your programming, ensure there's no double dipping on grant expenses, and preparing your statement of functional expenses. It makes it quick and simple at year end. So in QuickBooks, there's a report known as your profit and loss. For not-for-profits, those are your statement of activities, a report that shows revenue, expense, and net income over a specific period of time. It is the essential financial statement for nonprofits and crucial for demonstrating how well you're doing. It can help you categorize your revenue and expense to identify the need to adjust your programming. In QuickBooks, there's also a statement of activities by customer, also referred to as funding source. So each funding source can be set up as its own customer, and income and expense can be allocated to that specific customer. So this is an example of what a profit and loss by customer or funding source would look like. In QuickBooks, you would set up your grants as a customer. You would set up your general fund as a customer. And while this is setting up for grants, oftentimes by tracking your expenses this way, you can also see if it's a grant, it's for a program, is it for management in general? By using both the class system and the funding source system, that gives you a way to track what I was talking about earlier. Maybe your funding source allows you to charge management in general, but for your statement of functional expenses, that needs to be shown not as a program. So we do give you a description of how to add customers in QuickBooks step by step. Our presentations will be available after the conference, available on the Dannible website. So feel free to look at this step by step. And here we have a screenshot just showing you how you would add that customer in QuickBooks. You go to customers, you go to your new customer, and it'll walk you through the prompts from there. Then I mentioned the statement of activity by class, also known as program. So each class should be set up, each program should be set up as its own class, in addition to fundraising having its own classification and management in general having its own classification. And here's an example of what that looks like. So again, we have the directions to add your classes in QuickBooks. So feel free to go through these after the presentation. Our accounting services department is also QuickBooks Pro certified and can assist as people need. So here you can see to add classes in QuickBooks. In your invoice transaction, there is a class module on the lower right where you can select an existing class or add new, in which case you just follow their QuickBooks prompts. QuickBooks Online does have a great online how-to. If you Google how-to anything in QuickBooks, you will almost invariably end up in their help with screenshots available. So we have our next poll, and we've got 40 seconds for you all to get your answers in. Hopefully we don't have too many technical difficulties on this one. So how does your organization track expenses? Are you tracking it by nature and function? Are you tracking it by funding source? Are you tracking it by all of those items? Or are you going, I'm going to ask my accountant at the end of the year, they got this. I'm going to hope for the best. We've got some answers coming in. We have one clear leader, but I'm seeing a little more diversity in these answers than we historically have. I appreciate the honesty there. Just one more second. All right. So it looks like the majority of you are fulfilling the requirements both to track for your statement of functional, and the funding source will help you with your grants, which we spent a lot of time on last year. A lot of you are halfway there. For those of you who recorded to ask my accountant, thanks, you're keeping us in business. So next we're going to go through your common pitfalls and best practices.
Okay, so the common pitfalls, as we wrap this up. So we over allocating to programs without support. So obviously, you know, when you're doing grant vouchering or looking at your functional statement, you know, you really looking at it, a lot of people want to like do as much to program, but you know, just keep in mind, it's not necessarily you got to do what is right and what the data is showing you. Inconsistent methodologies year over year could be a problem. Lack of documentation, not documenting what you're doing, not keeping timesheets, not having the square footage all documented. All of that stuff needs to be documented so that if somebody comes in, maybe a granting organization comes in and wants to do some testing of the allocations, I mean, that you actually have the documentation available for them. Treating allocations as an afterthought. So again, it shouldn't necessarily be an afterthought. It shouldn't be let the audit firm figure that out at the end of the year. Misalignments with actual activities, confusing indirect costs with program costs, and overcomplicating the allocation. So there's a cost benefit relationship to this. So trying not to overcomplicate it. Okay, confusing indirect costs with program costs. Certain grants will allow organizations to charge overhead to the grant to recoup operating costs. This does not inherently mean a cost is a program cost. It's important the organization establish guidelines to identify and track those costs for grant reporting when they may be reported as management in general for the statement of functional expenses. This is a benefit of using both the class and customer functions in QuickBooks. Documentation. So best practices, documentation. Maintain detailed records to support the allocation methods. Consistency. Use rational, repeatable methods. Oversight. Have independent individuals review a member of management, supervisors, or an outside accountant. And establish a written policy for allocations, i.e. an internal accounting manual, memos, or standard allocation worksheets. So some more best practices. Expense allocations are a management estimate and some judgment is required. So we've talked about that. A lot of the portion of the functional statement is an estimate. There's always judgment required in this. So there's not necessarily, sometimes, in looking at your judgment, as auditors, as if you have this judgment and that's what you can kind of prove to us in the thought process, and then we would go with that. The level of detail needed to allocation expenses will depend on your organization's needs, including grantors' expectations, the needs of your board of directors, the trustees, materiality, and available resources. When in doubt, consult your accountant.
We did mention how there are some organizations that will just go through their expenses at year end and say, okay, I think my office supplies are about 75%, and I think my rent is about 40%. One thing we'll note, estimates are okay. Ballparking those percentages is okay if it's based on legitimate data. The trick here, you shouldn't just be looking at your expenses and say, everything is 50-50, everything is 70-25. You should still at least be going to a level of detail in your estimates that you are considering each line of that natural classification separately as you are doing your estimates. So we have our last poll of the day. We do have the QR code on the screen again. You can use that or log in to the DMCPAS link in the chat to answer. We've got about 30 seconds left to answer this poll. So after listening to this presentation, your organization needs to go back to the drawing board. For the most part, you've got this, maybe just a few tweaks, or you're actually perfect. Now, I don't know about y'all. I would love to see some perfects. I don't know if we've ever found a perfect organization, but some of you are rock stars, and we are here to help those who need a little bit more. Our poll's up in just a second. And it looks like for the most part you've got it, but just a few tweaks. Those of you who are perfect, we would love to work with you. We'd be happy to do your audit.
Okay, conclusions and takeaways. The statement of functional expense is more than a compliance requirement. It provides accurate tracking and thoughtful allocations are critical. Assist management and the board in decision-making and strategic planning. Strong policies, consistency, and transparency build trust. Provides key information to current and prospective grantors and your donors, and continuous improvement opportunities. Oh, we have about 3 minutes left.
So we'd like to open it up if anyone has any additional questions. Say definitely. Thank you all for attending today.